Good afternoon, everyone. Thank you very much for joining on this momentous day in history of the UK. Hopefully you have got over Fright Night or indeed the budget or one of the same. So the last couple of days were very interesting in regards to tax and in regards to some scary things happening. And today it's a great pleasure for me to join you and talk to you about some of the tax changes which are coming in, how they're going to affect you, and what can be done. So today is my budget briefing. There's quite a lot to get through. So there will be a chance to ask some questions towards the end. But if we overrun, then I will be adjusting those questions personally because today is really about the information getting out to you. So thank you very much for joining. For those that don't know me, my name is Mitch Young, also known on social media as Mitch the Taxman. So if you are watching this live and you'd like to interact, please feel free to tag at Mitch the Taxman across Instagram. If you are enjoying today, maybe you are spending lunchtime listening to me. So it'd be great for everyone to interact on social media. So please feel free to do that and I will repost them later. Just to let you know, my organization is called the Fusion Consulting Group. And as some of you know, I feel very passionate about creating a professional services group for a business owner or a family. So rather than going off to your accountant down the road to explain some tax strategies to then get some financial advice, my organization, the Fusion Consulting Group, has all these advisors in-house in the same company, helping you to obtain optimum efficiency quicker and simpler. So that's just a bit of a plug about my company, Fusion. But let's get straight into it. So these are the key topics of which we're going to discuss today. So we're going to talk about the key taxes in the UK. We're going to talk about personal tax. I'm going to spend some time on the residency and non-domicile changes. Spend quite a bit of time on inheritance taxation, capital gains taxes, of course, property and businesses. And then, as I've said, if we do have time, we'll finish with some Q&As. Just to let you all know, it's a question that does come up on every single webinar. This webinar is being recorded and there will be a recording sent out after today's webinar. But thank you all for the chat. It's nice to see some friendly faces on here and everyone joining in. So that's brilliant. Okay, let's just go through some high level headlines of the budget. You've all seen it by now. You've all heard the news and the £40 billion of tax rises, which is an incredible number. And we're going to go through where that is all coming from. Significant chunk of that is coming from employers, and in particular, the rise of national insurance. The changes to inheritance tax. Now, the main rate of inheritance tax wasn't changed, but essentially what was changed is some of the assets which are brought into tax and some of the reliefs which are being reduced. Of course, we've also seen the main headline rate of capital gains tax being increased. Maybe this is some good news in the sense that it wasn't increased to the levels that potentially one was speculating. We've seen a rise of stamp duty on second homes, which was quite surprising. And of course, the non-dom regime being abolished. So those are the headlines, lots to sink our teeth into. Oh, excusez-moi. Okay, so we'll start with, I guess, the simplest of them all in terms of the changes to personal tax. So the Labour government said they weren't going to change personal tax, income tax, and they haven't. And what I found interesting, that was no major changes to dividend taxes as well. So those rates are remaining. Some good news, I guess, is that she said there will be the tax rate threshold becoming unfrozen from 2028. So essentially what that means is that the current rate bands will be adjusted in line with inflation in 2028. So the Conservative policy was essentially to freeze the tax bands. So as people's salaries increases or their income increases year on year, more people are brought into the higher rate of tax. That was the idea. So that's going to be unfrozen from 2028. Another point, I just sort of lumbered it into this section, is around HMRC. Obviously, some of you know I like talking about some changes and what's going on with HMRC, and they've confirmed that they're going to continue the investment into HMRC, in particular the compliance department. So essentially we're going to see 5,000 new compliance officers coming in to HMRC. This is likely to lead to more investigations, more demands in terms of outstanding tax. Speaking of outstanding tax, they have said that they're going to increase the interest rate of outstanding tax by 1.5%. So currently, the interest rate that HMRC charge on unpaid tax is 7.5%. That is going to increase to 9% of interest on outstanding tax. The other thing that they've committed to do with HMRC, twofold. The first is to continue to modernize their systems, whatever that may mean. And the final thing is a continuous clampdown on umbrella companies. Okay, so I'll just talk you through this next section, and it can be quite technical, but it's an important part of the changes to tax. And I know we have a number of clients and a number of people on today's webinar who are either non-domiciled and concerned around these changes. Okay, so essentially there is the abolition of the non-dom regime, and in particular the remittance basis of tax. Instead, that is going to be replaced with a new 4-year foreign income and gains regime, okay, abbreviated to FIG. So if you hear me talking about FIG, it stands for foreign income and gains. And essentially, for anyone that comes into the UK from overseas, they will have the first 4 years of their residency with 100% tax relief on their foreign income and gains. Okay, some technical points here. They must have not been UK resident 10 years prior to arrival. They must submit that claim on a self-assessment. It can't be automatic. And if they are to claim that FIG relief, then they will lose their personal allowance and capital gains tax allowance. Now, some income won't be included in terms of their foreign income and gain. The majorities are, but there's some nuances there, including foreign pensions and in particular offshore life insurance bonds and income from overseas activities. So we really need to get into the technical detail when we are advising clients who are coming into the UK around their foreign incomes and segmenting that. So that is all to do with into the UK first 4 years of residency. The next part is, I'm not going to spend too long on this. The next part is in regards to settlers of protected settlements. So this is essentially overseas offshore trusts that have been settled many years ago. Previously, these offshore settlements were protected from UK tax, but essentially from April 2025, all the income arising under these offshore settlements will be taxed on the individual who set them up, i.e. the settlers. There might be some opportunity for capital gains rebasing, but again, this only applies for certain conditions. But a point which some of you may be interested in is a slight change to overseas workday relief, where in the past relief was available for the 3 years of employment. That is now being increased to 4 years, and some other couple of tweaks to overseas workday relief. You do not now require an overseas bank account to claim it. You can claim it via a UK bank account, and there's a financial limit, which is essentially the lower of £300,000 or 30% of equal to the earnings. Promise you we'll get past all the technical stuff shortly. But we've got to cater for everyone as best as we can. Okay, so that's the settlers. We then have this, I guess, window of opportunity for existing non-DOMs in the UK. And this is in regards to the temporary repatriation facility, or abbreviated to TRF. So what this means is essentially from April 2025, if you're a non-domiciled or previously classified as a non-domiciled individually, you have a 3-year window in order to elect income to be remitted into the UK. And if you were to do so, you would benefit from this, it's called a designated tax. So a tax rate of 12% for the years 25, 26, 26, 27, and then 15% in the final year, 27, 28. Now, what this may be useful for is if you have things like a mixed fund account overseas, then you can remit that at a rate of 12%, where, moving forward, that will be at the highest rate of tax. So there's quite a lot of planning to be done for existing non-dom individuals in the UK and what they can remit into the UK at a lower tax percentage point from April 2025. Okay, and then finally, just on the previous resident non-dom regime, we're focusing around inheritance tax. So now it is based on a residency tiered system. And essentially what this means is that all non-UK assets will be within the scope of UK inheritance tax if the individual has been resident in the UK for 10 out of the last 20 tax years. So that's quite simple. If you essentially are a foreigner or born outside the UK, you've got assets all overseas. If you remain UK resident for a 10-year period, so 10 out of the last 20 years, your whole estate will be brought into inheritance tax. In order to break that 10-year cycle, essentially, you're looking at a 9-year absence period from the UK in terms of residency, and then that cycle would start again. Okay, that brings us on nicely to the next topic, which is inheritance tax. Now, in my opinion, this is the biggest change in terms of affecting individuals and families, and there's been a lot of uproar around some of these proposed changes. So let's start with the nil rate bands. So the nil rate bands will be intact in its current existing format until April 2030. So we all know what they are, 325,000 per individual, with an additional 175,000 if you leave your property to your spouse below 2 million. So that whole situation with the estate valuation of 2 million remains completely unchanged. Let's look at some of the changes. And these are a couple of big ones. And I thought these were going to be changed as well. So this is in regards to business property relief and agricultural property relief. These are being reformed from the 6th of April 2026. So previously, what happens is that if you have a business, a family business, or any business that's trading, you could leave those shares on your debt, and they would not, you wouldn't essentially pay any inheritance tax, because they would qualify for 100% relief, sometimes 50%, but generally on the whole, 100% tax relief. So this made a lot of sense for family business owners, farmlands. They just go down the estate without being subject to 40% inheritance tax. Now what's happening is that there's going to be £1 million limit on this relief. And then above that, there's going to be essentially 50% relief on the value. So effectively, what that means is that you'll have £1 million as a relief from whether your shares or land qualify for business property relief or agricultural property relief. Then above that, the value would be subject to inheritance tax at an effective rate of 20%. Okay, so this is going to affect a lot of businesses, particularly a lot of farmlands as well. Really a lot of uproar on that, bringing that into tax. We've also seen a big change in and around pensions, and this is really key. So, as we know, previously one could pass on or potentially pass on a pension without the value of the pension being subject to the 40% inheritance tax. From April 2027, inheritance tax is going to be charged on unused pension pots. So a lot more inheritance tax exposure for clients, for business owners, for families. And, it's vital that everyone looks at their increased inheritance tax exposure and look at the options and planning, which I'll talk about a bit later. All righty, so let's get into capital gains tax. So we've seen the basic rate rise, which is the biggest rise, from 10% to 18%. This is now in. That came in on budget day. And we've also seen a rise of the higher rate of tax, or normal rate of tax, from 20% to 24%, which is in now. Residential property rates are in line with the above, no major changes there. And essentially, I think certainly at the main rate of tax being increased by 4%, one would have taken that before the budget. But my feeling with this is that this is only the starting point. Obviously, Labour have committed to their manifesto in the sense of not headline rising income tax in particular. So if tax is going to keep on rising, it's likely to come from capital gains tax over the next few years. But that's what it is today. And we've also seen a rate increase for those involved in private equity to 32% on their carried interest, which is one of the ways private equity employees get remunerated. Some good news is that business asset disposal relief will essentially remain. It remains at the £1 million level. There was speculation that may be withdrawn, but that remains at £1 million. Essentially, what that means is that for business owners who are selling their shares or transferring their shares of a trading business, on that first £1 million, they will only pay 10% tax if they meet the qualifying conditions of business asset disposal relief. Okay, so one could argue there's a bit of a window between now and April to look at if you are selling your business, if you are thinking about transferring your shares, it could be an opportune time to shelter an additional tax saving, because essentially from April to 25 to 26, that business asset disposal relief rate on the first £1 million will increase from 10 to 14%. And then again, the following year, that is going to increase again to the lower rate of the capital gains from 14, and then it will be fixed at 18%. So some structuring to be done. Some, if you are thinking about potentially selling your business, it might be a good time to expedite that process to save a few £100,000. Okay. Let's move on to property taxes. So I think a bit of a surprise was around the stamp duty land tax increase. This is the bigger change to property. Of course, we've got the capital gains tax rates, but they were quite fixed on the property side. So I think the biggest change on the property side is the increase of stamp duty. In particular, the increase to stamp duty on the purchase of second homes. So second properties, buy-to-lets, we know there was an additional rate on there already, and that's been increased from the 3% to 5%, making it more expensive to purchase property, second properties in particular. There's also a bit of an increase on the flat rate for ATED as well. So ATED is essentially when you're purchasing properties over £500,000, residential properties within a sort of an envelope dwelling, which is essentially a limited company, etc. and that's been increased from the 15% to the 17% as well. The rules for stamp duty and purchasing 6 properties together remain unchanged. There's the reconfirmation of the furnished holiday lets to essentially be abolished. So that's going to be abolished from April 2025. And finally, what was essentially what's essentially rumored was that there could be NIC on rental income, and that would have been a nightmare for landlords, but that essentially did not come in. Okay, and we're now on to business taxes. So in terms of business tax, the main rate of corporation tax is going to remain at 25%. But the biggest blow to businesses and taxes was around the national insurance increase. So essentially, the main rate for employers, so the employer's national insurance rate is increased from 13.8% to 15% from April 2025. Not only that, the threshold as to when you start paying the national insurance has decreased from £9,100 to just £5,000. So essentially, if you are hiring someone on around £35,000, there's extra tax to pay of around £900. So whether employees are going to, suffer this in the terms of, a decrease of wages or whatever it's going to be, but businesses are going to have to fund that national insurance rise somehow, and because it is quite large. But there is an employment allowance increase from the previous £5,000 to now £10,500. Don't think the Labour government have done enough to encourage business owners and entrepreneurship myself, but there we go. So essentially, with this £40 billion of tax coming our way, now is a vital time to look at good tax planning. And some of the things that I would be looking at would be the residency position. And when I mean residency, I'm encompassing the domicile side of things. But from a residency perspective, a lot of individuals I speak to are a bit fed up with these tax changes. So they're analysing their options around remaining in the UK or not, or setting up overseas or not. So doing that analysis now to see whether you could fit that, whether you could save tax, whether it suits your lifestyle. If you're a non-dom listening to this, again, now is the time. Assess your options, understand what can be remitted, how it can be remitted, structuring if you're going to remain in the UK from an inheritance tax perspective. Trusts are a good vehicle. They still remain a good vehicle from inheritance tax. But the issue with trust is that you need to understand how a trust is taxed and whether you need control of the assets or not. I think one big area that one should be looking at from an inheritance tax perspective is life insurance. So essentially, you could take out a policy which covers the inheritance tax exposure. So if your inheritance tax is increasing, can you up your insurance to cover that? So good conversations between your tax advisor or in particular your financial advisor, is going to remain very important over this period of time. Family investment companies, so structuring your assets now. We know that with capital gains tax rising and with BADR, share sales and share swaps are going to be important, looking at that over the next period. So limited companies and families, structuring family investment companies might be a good idea for you. Now, the shares itself, as we know, that first million, if it's a trading business, will qualify for business property relief in terms of inheritance tax. But the idea is that you set up the structure with percentage ownerships day one, so that your children or your trust may own X day one. So that ownership will be sitting outside your estate, because they own X amount from day one, and then over time you just transfer more shares to them, because we want to get them more outside of your estate as possible. And then, as mentioned, are you thinking of selling your business? Is now the right time? Do we want to shelter business asset disposal relief at 10%? Let's have good conversations, see what can be done. The idea of tax planning and tax advice is all about providing you with the necessary information enabling you to make a decision. So, what I do and my USPs is around modeling. We will sit down with you or your clients, work out a number of different scenarios, and then illustrate the tax impact and tax savings of those scenarios. Because, of course, we know that one tax may be more favorable than the other in terms of savings, but also tax is only one element of your decision-making process. So we're not just a transactional tax advisor. We really talk about the future and then model out option A, B, C, D, and then together we work out the right route for you, the most efficient legal route for you. And then we essentially draw out a master plan, a master structure for you. And this is why our clients love working with us on the tax side. They love the work we do. This is why a lot of accountants and solicitors refer to us, because there's only so many people who can do this agile piece of planning, working day in, day out for our clients on this type of work, looking at the interaction between inheritance tax, corporate tax, income tax, capital gains tax. And of course, the tax structure will be the skeleton. And if you need a financial advisor to do the insurance products or whatever it may be, we've got all that in-house anyway. So I've got some interesting news for everyone, because we want to help everyone who's watching this, and indeed anyone who's on my social media who wants to be in touch as well. Anyone that receives tax advice from us in November, we will also be updating their will or creating a will for them absolutely free, which is worth £400. So we want to help as many people this month after the budget as possible. So if you do get in touch with us and arrange a consultation and we sign you up for tax advice, we will also draft your will with one of our legacy experts, or indeed update your will for absolutely free. Good. So we've been running for about 35 minutes. I'll just go through the chat bar and the questions for a few more moments to answer any easy questions. Otherwise, you'll be hearing from a couple of my colleagues to get some feedback from you and see if you'd like some tax advice. And all our consultations are free of charge as well. So typically they'll be with me or one of my senior advisory team. We discuss your matters, see if you need advice, and then we'll quote up a fixed fee. Everything we do is a fixed fee for our advisory work. So just scrolling down, we've had loads of people watching from all around the UK, Yorkshire, Liverpool, London, of course, Hearts, Poland, Switzerland. So we've got a question here. Is there any chance that capital gains tax will only be applied to the increase in value above inflation? This has subsequent effect on reinvesting buy-to-let property in the market. Otherwise, capital gains tax is just a tax on inflation. So yes, the way capital gains tax is going to work is the same as it always has done, which will be essentially the sales proceeds less what you originally paid for the property if you're, UK resident. So good question around withholding tax. Is there withholding tax relief for remitting of taxed abroad? So within that first 4 years, there will be. For the next year, for the first 4 years, there will be. When you are already non-domiciled and then you're going to go for the temporary relief, then there won't be. But I'll double check the guidance in that. Right, it's a good question on the pension. So, and this has come up in the press as well, quite highly criticised, is that with a pension, as we know, that's now going to be subject to tax. So the estate is going to pay 40% come April 2027 on the value of the pension pot. Then the beneficiaries, when they take out the money, they're going to be subject to tax at their tax rate band. So essentially, you've got to hit the 40% on the inheritance tax, and then it comes to the beneficiaries. If they're going to use the pension, it's going to be taxed at their band. So essentially, like a double hit there on the pensions. Do you know if there's any changes to inheritance tax on the estate with value over 2 million? There's no tax changes for estates over 2 million. It's the same as what it was, in a sense of if you have an estate over 2 million, then you will lose the right to have the additional nil rate band of the £175,000. Another question here. Does a person with a UK domicile of origin fall outside the worldwide inheritance tax after being non-UK resident for 10 years? Yeah, it's a good question. So yes, essentially, if you were previously UK resident for that 10 out of 20 years, you need that consecutive period of absence, 9 years, to essentially fall outside the inheritance tax. So that is correct. What date does the new CGT take effect from? That was from the 30th of October. So the new capital gains tax rates are already in. So some great questions there. Thank you very much for joining me. Please tag me on social media if you've enjoyed today's webinar at Mitch the Taxman. The key takeaway is that between now and April would be a perfect time to look at your tax planning, sheltering some capital gains tax reliefs, but also the key thing will be about inheritance tax planning now. So consult your advisors. Of course, I'll be doing some more webinars, so look out for that. If you do want to get in touch with me, my email is mitch@fcg.co.uk, or indeed you can message me on any media format that you'd like. But hopefully you enjoyed today's webinar, and I look forward to speaking with as many of you as possible in the near future. Thank you very much.